Hey folks, welcome back to this edition of Ben's Bits. We're continuing discussing the topic of retirement and how the investment vehicles that you choose have a direct impact on your portfolio. And last week we discussed the effect of failing to deploy capital sitting in an IRA and how it costs you, not only in your returns, but how you need to work longer instead of enjoying your retirement. And this week, we're going to be discussing one of the biggest myths out there and how truly devastating it is for not only your retirement, but for your financial life as a whole. And it's a position that the majority of not only investors, but the nation as a whole finds themselves in. And it reminds me of the lobster in the boiling water analogy, the one where the lobster slowly boils to death while not really understanding the danger it's in. And I know you're probably saying right now, Ben, you're kind of freaking me out. What is it already? Well, let's talk about what's considered to be the safest position with the least risk involved and the perception of no danger. Cash, right? Sitting in a cash position. And we've all heard that in some point in our lives, right? You've likely heard that sitting on cash or having cash on hand is the safest bet. But is it really the safest? Well, let's look at the benefits. There's no risk to it and you can't lose it. Really? You're not exposed to the market, so you can't lose it. Really? It's the rainy day concept while you have access to it if you need it. You guessed it. Really? Let's look at it from a different perspective. To prove a point, let's look historically at what essentially is time value of money, right? And how sitting on cash is one of the worst positions to be in for investment purposes. Think back to when your grandparents spoke of better days where you could go out to the local malt shop and they could buy a piece of candy for a nickel. And then your parents come around when they go to the local store and they buy a piece of candy for about 25 cents. Then we come of age and we go to the local convenience store to buy a piece of candy for $1. Now for those of you who have kids, what's the price of that same piece of candy for our children? It's about $2. So let's look at the point of this bit to really drive it home, where you start with your grandparents and they are nickel, and you translate that to your parents, and it took 5 nickels to equal the value of that same nickel earlier to buy that same piece of candy. Then that same nickel that your grandparents had takes 10 times the amount to buy the same piece of candy, leading up to this generation who needs 20 of those nickels for the same piece of candy. And finally, our kids needing 40 of those nickels to get the same piece of candy. Do you see the trend here? Every generation is doubling the money needed to purchase something that was essentially half the cost of the generation before. Do you see this? By sitting on cash, you're actually accelerating the loss of value every year. Not only that you're having to work longer into your investment years to help offset those losses. Not only that, for those of us who want to leave a little something for our kids, you might as well give it to them now because they have double the purchasing power with today's value and can at least enjoy it a little, right? And I say that kind of tongue-in-cheek, really tongue-in-cheek. But back to the original question, is cash really the safest play? I think you're starting to see why it's one of the worst investments or positions that you can be in. So that's it for this edition of Ben's Bits. And always, thanks for watching, and we'll see you next time.